in here at the auction itself. Substantial number of buyers. And what we also suggested this morning was the inflation break-evens, guys, were relatively bullish bonds into the close, weren't they? Did you remember that commentary we had in the inflation break-evens into the close? We mentioned it this morning. So we had a look at the closing bell here, and we drew this line in for you, and we suggested that inflation break-evens, boys, were bullish bonds into the close. As we've covered on many occasions over the last few years, inflation break-evens bullish, suggesting that there is going to be a miss on these numbers, and that's why we weren't going to be too caught up with what was happening on our volatility spreads, because that's why we covered that volatility analysis, because most people would read that volatility print from yesterday as very bearish equities. Well, we were very careful to remind everybody that that's not necessarily a correct, accurate read. High volatility doesn't necessarily mean bearish. It means high volatility, surprisingly enough, which is what we were trying to recognize and be able to spot. So based on this read from yesterday, we were looking at the market from a bullish point of view. And obviously the takeaway from that was that we've just had an absolute cracking winner from 42.08. So if you still held on to that measured move profit, 42.8, and we've just traded 44. 17s, 18s, 19s, so $2,500 of profit. If anybody was trying to get long into bonds the way we were, then it kind of made an awful lot of sense. Overall, a very, very happy result for everybody, I think. Very, very happy result for everybody. Let's get through the numbers. CPI numbers, headline 0.1 against a forecast of 0.3 prior of 0.4. Year-on-year CPI 7.1, 7.3 forecast, 7.7 prior, and core CPI 0.2 against a 0.3 forecast. Now, if we look at what morgs were saying about that number, let's take a look at what their forecast was against the number itself. So obviously the headline is what they were talking about, 7.1%. So we're going to take a look at that number, 7.1% GP morgs, and we'll work our way through what their scenario was for that type of number. Okay, so we can see that here's JP Morgan's trading scenarios. Prints of 7.8, 7.5 to 7.7, 7.2 to 7.4, 7% to 7.2%. So this is their print, okay? This is their forecast. So JP Morgan's forecast, 15% chance that it was going to be that low. Now that means that this is an outlier. Do you understand? That is an outlier. So a 15% chance, a bullish outcome that could pull terminal rate lower despite expectations for higher dots being released the next day. While 2 data points is not a trend, this may embolden bulls, especially if commodity prices continue to decline. GPM sees the S&P going up by between 4 and 5% in that scenario. Between 4 and 5% on that scenario. So that's obviously what we're looking at here, 4 to 5% on that scenario itself. Now obviously, you know, you've just seen it from JP Morgan's. You can see that you've got that idea. You see it is a big outlier. It's not the high probability trades here. It's not the 50%, 40%, 30% trades. It's a 15% probability scenario. And it's a bullish outcome, 4 to 5% upside from that scenario. Now 4 to 5% upside means about a 200-point move on the S&P could be starting to work in, right? 200-point move. Well, when we look at the S&P, of course, a 200-point move, we've just went from 40.40 to a high print there of 41.80 for a 140-point move. So, you know, 4 to 5%, 200 points, we're not a million miles away from that number, are we? 4%, obviously, you're looking at about 180. We did 140. So, you know, they're not a million miles away from that spike. Not a million miles away from that spike, but obviously an awful lot of that upside was already coming into the markets from the day before's close. So you're already coming away from a price of about 4,000, 40/20s. So 10%, 400, 5%, 200. So you're looking at 4%, maybe 160, 170, 180, and you're coming off 4,000. So 4, 180, probably about the right kind of price level for that type of scenario, right? Would you agree with that? Simple thinking, guys? Does that make relatively good sense? Does that kind of line up with what JP Morgs were saying? Yeah, pretty much. Pretty much. Nice outcome, guys. You managed to get a piece of that jigsaw puzzle. I like your style. I like your style. Obviously, that's helped gold off to a rip-roaring upside as well, which is good news for the gold markets. Not so good news for the inflation, with the oil prices also catching a nice buy-side popper off that, which is okay for us because remember that benchmark buy trade I was talking about on the oil. Remember that one? Well, you'll be liking it now even a little bit better, right? You'll be liking it a little bit better now because we've just went from $73.20 to now $74.80, $1,600 profit on the spike, and time to just bag a little bit of money into that on that dollar weakness storyline. Very, very, very good outcome for anybody that benchmarked your oil against that trade level. So fantastic news, great outcome. We love a great outcome like that, guys. We absolutely love it. Hopefully you'll be understand. Whether you got the trade, whether you didn't get the trade, it's about understanding. But at some stage, you've got to make that decision as to whether you want to trade these types of data releases. If you never want to trade them, that's absolutely fine. As I said, I don't have a problem with that. But at least understand them. It's incredibly important that you understand these releases. And that way you don't get trapped by them. That way at least you remember that they're coming up so that you're not in a position that suddenly gets wiped out massively, as well as your account in one single go. Make sure you don't get trapped on these simply because you forgot about them. So it's important that you get to know and learn and understand what's happening with these types of releases. If you can see it, you can deal it. It's as simple as that. If you don't want to deal it, you don't have to deal it. It's not included as part of the benchmarking process, remember. But the idea is, at least if you understand what it's doing, you're not caught by it, and you can understand a little bit about the follow-through and various other things. This could have a very decent follow-through narrative. And for that reason, of course, it's not one of these kind of markets that I'm instantly going to step in and start fading anytime soon, because it will have a knock-on effect for the Fed as well, which obviously is something that we have to take into account when it comes to tomorrow's FOMC. I mean, they're obviously going to be seeing this. So we know that they're going to be seeing this number. They're going to be paying attention to this because it is important, isn't it? It's very, very important.